So I'm very excited to have Bill Schnorr as moderator of this panel. He is a partner at Goodwin Procter. His clients include Zendesk, HubSpot, Athena Health, and Imprivata. I'm sure many of you are very familiar with these clients. He is very much at the center of the Boston tech scene, and in fact just completed the Boston Marathon. And joining him as guests are Jeff Epstein, who's the operating partner at Bessemer Ventures. He serves on the boards of director of Kaiser Permanente, the Priceline Group, and Shutterstock. And he previously was CFO of Oracle, as well as DoubleClick. In addition to him, we have David Rosenblatt, who was also part of DoubleClick. He was the former CEO, and presently is the CEO of 1stDibs, which is the world's leading online marketplace for the most rare and most desirable objects. David is on the board of Twitter and ISC, so I'm sure many of you are familiar with many of these companies. So please join me in welcoming them onto the stage.
Okay, thanks, Victor, for that warm intro. This is always perilous duty, being the last panel before cocktail hour, especially with a group of Yaleys. But we'll do our best to hold your interest and attention. So what we're going to talk about, we've got about, it's about 40 minutes, and we're going to have some Q&A at the end. We're going to be addressing the issue of transformation as viewed from the boardroom. So I think that, particularly for younger entrepreneurs, it's really important to recognize you're all ultimately driving your businesses, probably in most cases ultimately be taken out in an acquisition by a bigger company. The IPO opportunity is always there, but that's frankly a little bit of the rarer way to get out, and so M&A becomes pivotal. And in that role, understanding how directors think and how they, because ultimately decisions for really big deals, and hopefully you are selling for a really large amount, is made in the boardroom. So we've got two speakers here today with just phenomenal experience, both as directors and executives of bigger companies, the acquirers, and also the emerging companies, the targets and the prey. But since we are talking about transformation, what I want to do at the outset, Jeff and David, is ask you each just to reflect back on your career and the changes you've seen, and what's an example of transformation that kind of really sticks out in your mind. It can be business model, it can be technology, market, you name it.
Okay,
Jeff?
Terrific. Thank you very much, Bill, and thank you to the Yale community for inviting us to be here. It's great to be here. And before I answer that question, I'll just point out that Dave and I have a lot in common. We both went to Yale undergrad, we both went to Stanford Business School, work in the technology business. But you just have to be prepared if you go to Yale and work in technology to lose your hair. That's an important part of the thing. So,
go to law school.
I've been on the board of Priceline now for 12 years, and Priceline is just a remarkable story. It went public in 1998 and very quickly grew to a $30 billion market value during the internet bubble. And Priceline's core promise to consumers at the time was name your own price. And it was name your own price for airlines, and then it was name your own price for mortgages and groceries and gasoline. And there was a thesis in 1998 at a $30 billion market value that Priceline would become the discount version of Walmart and become a giant e-commerce company. And that turned out not to happen. And so you talk about transformation when the internet bubble burst and all of these other businesses other than travel turned out to be enormous money losers. Priceline stock went down 99%. So it went down from $30 billion to $300 million. It was losing a lot of money. People thought Priceline was going to go out of business. And I joined the board in 2003 when it had recovered a little bit. Its market value was about $1 billion. And we did transform the company. At the time, it was only at that point, they had cut back everything other than name your own price airline travel. And what we're able to do is we're able to go from just name your own price to regular airline travel. And then we added name your own price hotels and regular hotels. And then we grew internationally, and we made an acquisition in the UK and in Europe and in Asia of hotel travel agents. And today, we are the largest hotel travel agent in the world, and the market value of the company is $60 billion. So to go from $30 billion to $300 million to $60 billion over the course of 17 years has been quite a transformation.
Sort of like my Boston Red Sox going from World Series to last place to World Series. Thanks, Jeff. David, how about you?
Yeah, it's a difficult question because almost by definition, any successful internet company ends up disrupting its industry and therefore representing its own kind of example of transformationalness. I guess for my direct experience, the one that has been the most spectacular was the industry that we created at DoubleClick. And actually, I guess it's not just our hair that we have in common. The DoubleClick story, minus a few zeros, sort of follows a similar path to that of Priceline. The company was founded in 1996. By mid-2000, we had a $15 billion market cap. We were public. About 18 months later, we had a negative enterprise value, meaning our market value was less than the amount of cash that we had. We ended up taking the company private and really pivoting the business around the DoubleClick ad exchange. And essentially, the story behind that was, we developed technology that basically acted as the kind of platform for all display advertising on the internet. Most of that industry was run similar to the way it was offline, meaning advertising was bought and sold kind of the old-fashioned way, over 3 martini lunches and the like, and we supported that process. In mid-2005, we perceived that Google was directly focused on disrupting us, and at this point, the details don't really matter, but our competitive response was to try to shift the way advertising was bought and sold in the display category. And basically what we were trying to accomplish was changing from a model where advertising was bought and sold in the way that I described over lunch, in a very sort of structured way with long-term plans and so on, to one that looked much more like the way financial securities are bought and sold, through a marketplace, live, real-time, where there are no long-term commitments. Most of it is done via computer screen rather than face-to-face. That industry, which is called programmatic, is now probably a $40 to $50 billion industry, and that was really almost entirely driven by the commercialization of the DoubleClick ad exchange, which not only disrupted the industry, but also disrupted our own historical business. We ended up selling the company to Google in mid-2008, and the business as it is today is, I think, in gross media terms and in gross revenue terms, is second only at Google to search in size.
Great, thanks. So now let's shift our focus into the boardroom, now looking at it from the point of view not of the emerging company, but the bigger company, a company that's got a great market position, profitable business, growing, at a decent clip, but not robustly, suddenly faced with the risk of transformation in its market. So let's say you're Oracle, and you've got this great enterprise license model and maintenance fees, and all of a sudden the cloud comes and SaaS emerges, or you're IBM and you're dominant in mainframes, and all of a sudden everybody's running around with PCs. As a board member, as a member of senior management, how do you know when it's time to try to stop hoping that the change won't happen, recognize the change for what it is, and then adapt to it, either by changing your business or going out and buying something? How do you do that?
I'm going to give you 2 answers. The first is how a company like Oracle thinks about acquisitions in general, and then how it reacts to something like a disruption change like cloud computing. So Oracle has a phenomenal acquisition strategy, and it starts with the product. So the engineers will look at a customer or a type of customer, like they'll go to JP Morgan, and they'll say to JP Morgan, tell us about all the 10,000 different enterprise software products you use. You have something to monitor mortgages, trading, credit cards, consumers, you have an HR system, you've got all these different internal systems to run your bank, and literally there could be 10,000 different applications. And so we would then create a map of all the different applications and technology systems, security, other things that a major money center bank would be buying from an enterprise software provider. And we would code red products where Oracle had a competitive product in that category, and then we'd leave it white if Oracle either didn't have a product or we had a product that for whatever reason was old or not very good. And then the product managers would say, over time, we want the entire chart to be red. We want to be able to sell every product to JP Morgan. And so we would have a build or buy approach. So there might be hundreds of boxes initially that are white, and the product managers would work with the customers, with the salespeople, and they would decide to prioritize which of these features and functionality and categories within a money center bank's application profile would be the highest priority. We then say, if we put 100 engineers on this project for 2 years, we could build a competitive product, or we could buy one of these 6 companies that are independent that are out there, and we'd go through this build or buy option. And then simultaneously, companies are calling us all the time, or investment bankers are calling us saying this company's for sale. If one of these companies happens to be a credit card processing company that sells to JP Morgan, we'd fit it into the matrix and we'd say, how does that change our build versus buy? And over the last 12 years, Oracle has grown probably about half and half. Half through internally developed software and half through acquisitions, which they then put through their machine. Now that's just in general about all acquisitions. And then when you have something that's completely transformative like cloud computing, there are a couple of issues. One is often it starts, if you've read Innovator's Dilemma, it starts at the low end. So it starts with smaller companies. Oracle just starts selling to the Fortune 500. So we didn't focus initially on products that were sold to companies with 100 or 500 employees. But the suppliers that sell to those small companies get better and better over time. And also they're generally cheaper. And so if we started competing initially, we would have to have a lower functional product with a much lower price and much less profit, and we'd be trading dollars of revenue for dimes of revenue, and that doesn't make any sense. So it's very natural that in new markets, the incumbent is slow to innovate, because innovation means cannibalizing your own business. And Larry Ellison, the founder and CEO, and now chairman of Oracle, I think did a pretty good job of seeing cloud computing coming. He personally was an angel investor in Salesforce. He personally founded NetSuite and owns half of NetSuite. But he was slow in having Oracle invest in cloud computing because he wanted to keep Oracle's profits up. And then I would say about 4 or 5 years ago, he went all in. Oracle's been spending billions of dollars now, both internally developing cloud products and acquiring cloud products at high prices. And the story's not over, so we'll have to see. Oracle's got about $35 billion in revenue, maybe 10% or less is cloud. And you've got to manage that transition so that as cloud becomes bigger and bigger, you've got a big enough part of your business that's in this fast-growing business. And we'll have to see whether they can do that.
Great. Thanks, Jeff. David?
Yeah, so it's interesting. I mean, Oracle, listening to Jeff, Oracle's point of view obviously originates from a company that's fundamentally a B2B business, meaning they're selling to businesses as opposed to consumers. I think the approach among consumer companies is probably slightly different, which is in almost any case, I think you have to assume that the disruptive threat puts your entire business at stake. And it's funny, the kind of expression that always comes to mind when I have these conversations is, I remember early in the digital advertising industry, having a conversation with some people about sort of the future relationship between television or offline advertising and digital advertising. And the question at the time is, do they converge? And if so, at what point? And so on. And finally, someone said, I think the two are probably going to converge in the same way that the car and the horse and buggy did. And so you want to be the car, right? So in consumer businesses, that very often tends to be the case. Companies really can go to zero, and the disruptor can fully displace the incumbent. And so, therefore, I think as the larger company, the one that's at risk of being disrupted, in all cases, you got to take it really seriously and make sure that, I would say you both have an organic effort pointed at that threat and also an acquisition effort pointed at it. There are legion examples. Probably the simplest one that I was involved with was Google and YouTube. So when YouTube originated and gained scale very quickly, Google launched something called Google Video, which none of you have ever used and probably don't remember. And that didn't really work. And at the same time, they had an effort to buy YouTube, and obviously that did work. And YouTube's, I don't know, probably a $7 or $8 billion revenue company now and continuing to grow quickly. You can look back on roads not taken. In the kind of social industry, for example, should a Twitter have bought an Instagram instead of Facebook? One could argue both sides of that equation, but clearly Instagram ended up being a real company and important in that category. And so I think, again, the short answer is you got to do both. You have to build organically and you have to look at M&A. And I think in the case where you look at M&A, I think it's you look at valuations like WhatsApp, and so on that seem very big. People thought the YouTube price was enormous at the time. I think if you're right that the company that you're looking at really is going to be the disruptor, almost no price can be too high. They all look smart in retrospect. And the last point on this is when you look at the really successful large cap consumer tech companies like a Google, like a Facebook, almost all of their new products were formed via kind of small tuck-in acquisitions that they then sort of plugged into the machine and made much bigger and more successful. In Google in particular, you look at something like Android, that was acquired. Maps was acquired via a company called Keyhole, and on and on. In fact, there are very few of the products that really matter at Google today. Search and Chrome are probably the two that come to mind, were fully built organically. Facebook is doing the same thing via Instagram and WhatsApp and others. Potentially Oculus falls into that category. So you really have to be good at both is the short answer.
Okay, so Dave, let me come back to you with a follow-up, and Jeff can have a shot at this too. You mentioned valuation, and you mentioned some really high-profile, high-value deals. When you're sitting as a director on the buying company side, how do you get comfortable with valuation? How do you think about valuation? How do you know that the management just hasn't fallen in love with the target? Because presumably, no matter how great the asset is, there's a price at which it just doesn't make sense. And how does that dialogue take place behind closed doors? Let us in on some few trade secrets here. Yeah,
well, it's funny. Jeff is the former CFO, and I'm the former operator. So I'm the guy who falls in love with companies, and he's the one who says, hold your horses. Look, there's no simple answer to that because, again, as I was saying earlier, when you end up buying the leader in a big market, again, in retrospect, almost any price is justifiable. I mean, if, again, people thought that Google spending $1.5 billion for YouTube seemed crazy. If they'd spend 3 times that, in retrospect, it would have paid out. Facebook buying Instagram for $1 billion, again, seemed like a gigantic number at the time. The company was 18 months old. It had something like, 30 million users. Again, many people believe Instagram is a substantial percentage of Facebook's market cap today. So again, I think that it really boils down less, from my point of view, and in the kinds of companies that I've been involved with, less to a financial basis and more to a strategic basis. And that's the role that boards play, is really kind of drilling in on the kind of strategic rationale and logic, and sort of getting comfortable with that. Because if you get comfortable there, again, you should be relatively price insensitive. If you can't get uncomfortable, almost any price is too much. And so it's somewhat of a binary result.
I agree with David that you have to catch these companies at the right time that are extraordinary companies, but you also have to be right. And there are famous examples of people who have been wrong. So News Corp famously bought MySpace when it was growing 100+% a year, thinking it was going to be Facebook, and they were wrong. I think perhaps they didn't manage it correctly, but it could also be that MySpace was just a much weaker company than Facebook, and no one could have managed it well, and MySpace would have declined anyway. So paying a high price for a fast-growing company is very risky. And I think there are 2 ways to look at it. One is sort of from a portfolio approach. If you were going to buy this company as a standalone company, will this be a good investment on its own? It's sort of the Berkshire Hathaway approach, or a private equity approach, or a venture capital approach. And then, but as a company, you have an additional advantage, which is there may very well be things you can do with that company that other people can't, and so it's worth more to you than someone else. And then what you want to think through is how will your revenue be higher, or your cost be lower on a combined basis than otherwise. And so I think a great example of that is when eBay bought PayPal initially. PayPal was a startup which was a payment service which turned out to largely be used by eBay sellers. And eBay had its own payment system which wasn't as good. They didn't do a very good job of executing. And so eBay bought PayPal, rolled it out to all their sellers, and it was phenomenal synergy initially. And then PayPal grew to be so successful that today PayPal's business is largely non-eBay sellers. And now you have these 2 companies, PayPal, which is a payments company, and eBay, which is an e-commerce company, which have some overlap but don't really have that much in common. And if you say, where should PayPal really exist, it probably should exist inside a larger financial institution. So eBay and PayPal now are in the process of splitting up. And it would not at all surprise me if 2 years from now, some big bank or Visa or MasterCard buys PayPal, and the PayPal asset, which made a lot of sense to be part of eBay for several years, now makes a lot of sense to be part of some giant multinational financial institution. And that's why these mergers and acquisitions happen, because assets at one point in time create value by being higher revenue, lower cost as part of one other group of companies, and then over time the world changes and it's more valuable as part of another group of companies.
Great. So now let's shift our focus not from the boardroom of the buyers, but the boardrooms of the targets, the emerging companies. There's been a lot of high-value acquisitions of relatively early-stage companies. I mean, I think of DeepMind's, which was acquired by Google. I think the company had 6 employees, and it was a several $100 million deal, and we're seeing more of those. So when you're sitting on the target side, how do you weigh the benefits and the trade-offs of an early sale where there's not been, from the founder's point of view, not that much dilution, still meaningful ownership, but presumably early enough in the process that you're leaving a lot of potential money on the table in terms of aggregate enterprise value, but with all the risks that continued success entails and the dilution from future financing. So how do you weigh and wrestle the current payday versus the future payday?
Oh my God.
So you're saying that if someone in this room, for instance, has a company and they get an offer for $500 million, should they take it?
I got one now. It's companies that literally, we don't have a single customer. We've got a professor and 2 grad students, and there's an offer on the table to buy it for $50 million. It's raising no outside money.
Okay, so I'll give you my personal view, which is
third company.
There's a certain amount of money which will change your life. $1 million may not change your life, but 10 or 20 or $50 million will completely change your life. And if you have a company where you can make change your life kind of money, and you don't take it, and then the market crashes or the Russian ruble collapses or whatever, and then you get wiped out, you sort of will probably feel pretty bad about it. But there are ways.
Your spouse might feel even worse.
So I guess my personal advice for most people would be either to take the sale or to try to get a secondary, so you could sell some of your stock at that very high valuation, because you've seen these just incredible changes in the capital markets that come and go, and that could be sort of a one-time type of thing. So I think it's very rational for people to do that, and one way to think about it is take some money. Probably the rational thing to do is to take some money off and keep some money on, if you can do that. Right.
Yeah, that's what I was going to say. I mean, to me, the biggest change in the market in that respect is the development of these markets that permit for founders to sell some portion of their stock. I mean, until very recently, that wasn't the case. And so you always had this binary decision of, do I sell the dream or do I own the dream? And owning the dream carried a lot of risk. Now you don't have to make that decision, actually. So the right answer, I think, is that. To take some money off the table and hold on to the company and, see if you can make a go of it. I will say, from the entrepreneur's point of view, the opposite of the phenomenon that I described for big companies is true for them. In other words, for big companies, my point is, at least in the consumer market, no price is too high for a company that's going to be successful. But that's also true from the point of view of the entrepreneur. A price that can seem extraordinarily high at an early stage in the company's development actually can look quite small with the benefit of hindsight 5 years later if the company's successful. And that's happened time and time again. And people have left tremendous sort of intergenerational amounts of wealth on the table by taking that that check. And again, I think if you can sort of accomplish a way, it's not that easy to do, to get the best of both worlds by getting some liquidity but retaining exposure to the ultimate opportunity, that's where you want to be.
If I can just describe something that Priceline's done extremely well, they are expert at acquiring companies founded by entrepreneurs and structuring the deal in a way that continues having the entrepreneur stay at the company and have a big stake in the game. And so several times now we've bought 70 or 80% of a company, leaving 20 or 30% in the hands of the founders, and then having buy-sell agreements over the next 3 years where in every case that we've done this, the company has done so much, has grown so quickly, that the 20 or 30% that they kept was worth more than the 70 or 80% they sold initially because the valuation per share was so high. And so that was, just Priceline's been extraordinary in finding these great companies run by brilliant entrepreneurs, keeping them motivated, keeping them excited to stay within the Priceline world, making sure they get rich, but also having that entrepreneurial energy within a big company. And that's pretty rare, because most of the time big companies acquire entrepreneurs, and the entrepreneurs want to leave as quickly as they can to get out from the bureaucracy. So it's a pretty rare ability for a large company to have.
That's great.
Yeah, that also applies in some cases to startups within big companies. And probably the best known example, and a public one with a company I'm involved with, is a product many of you hopefully have used, Tinder, which was started under the auspices of IAC, and it's been, again, pretty well publicized. The founders retained a chunk of that, and it's done extremely well.
So does Tinder have any revenue now, David?
It does, actually.
Oh,
yeah.
Okay.
That's great. Okay, so here's one of the eternal questions that we should kick around and have some fun
By the way,
with.
Chuck, you wouldn't know because you're not a user, but there are paid.
Well, I know they had a lot of users, but my impression was
Who
it was
here's a
free.
user?
So
Everybody close your eyes. Raise your hand.
I was wondering whether it was a hobby or a business. That was my question.
right.
Lifestyle business.
Be both.
So are companies bought or are they sold? Targets, they bought or they sold?
So, I mean, you've run corporate development departments.
Right. Well, there's a famous saying in technology in particular, in software, that companies are bought, not sold. And I think the point is, when I was describing this, the JP Morgan sheet that Oracle had, if you come to Oracle and you say, I've got this great product and we sell software for dentists, and it's a phenomenal opportunity, Oracle would say, well, we don't sell software to dentists, we don't care, so it's just not of interest to us. But if we have software selling to banks to help manage credit cards, then we're very interested. So I think the point is, large companies have their own strategic plan about where they want their products and customers to be from a product point of view, customer segment point of view, geographical point of view, a business model point of view, whether it's on-premise or SaaS. And they're going to go through that, they're going to do that strategy, and then build or buy as a technique. And so if you happen to be a company and you fit into that strategy, if they're doing their jobs, they should know who you are already. They should be talking to you and trying to wine and dine you so that when you're ready to sell. Now, it could be that maybe your best fit is with a smaller company. They don't have too many corporate development people. So as an entrepreneur, it's a very good idea for you to build relationships with the 5 or 10 companies that might eventually acquire you, so they know who you are. They see how you could fit in their plan, again, on a B2B basis. If you just call up a company, if you're the seller and you call up a company and say, you've never heard of me, but we have a great business, I think you are not likely to get a good response.
Right.
Yeah, I would say most companies, for that reason, are bought. Every company should be sold. And my advice to people who run companies I'm involved with is you should always be thinking about the sell option. And the sort of analogy that I always use, and what I have and do use, is the kind of stolen from the intelligence business, where there's this sort of concept of sleeper cells, meaning you sort of have people in different countries, and 99% of the time you don't use them. But if you need to use it, you have people that you can sort of activate and can go into action very quickly. And the way that works with M&A is, I think any small company should always be thinking about sort of what is the possible exit path, and building relationships with logical acquirers. And again, I don't think it takes a lot of time. It could just be as simple as having a relationship with the relevant biz dev or corp dev person, so at least they kind of understand what you're doing. You can have that meeting in the context of business development opportunities. But the value of that is, so when the big company like an Oracle shows up and says, we want to buy you because you fit into this white space in our 2x2 matrix for a given market, what they're going to try to do is they're going to try to make it non-competitive, because that results in a lower price. What your goal should be as an entrepreneur is to make it as competitive possible. If you have 0 relationships outside of that one acquirer, you don't have the time to do it. It's too hard. And also, you risk alienating the buyer. On the other hand, or the original buyer. On the other hand, if you have this sleeper cell, you can very easily kind of in the background call them up and say, look, we're not necessarily selling the company, but we do have this option, and to the extent that you're interested in exploring that as well, we need to know in the next 2 days. And it doesn't. You don't have to sort of cycle through all sorts of meetings, and you can create an auction very quickly. And at that point, the risk of the original bidder walking away is a lot lower, because that bidder then puts themselves at risk of their competitor owning the company. And my understanding is that Oracle sort of participated in a bunch of those things and ended up, Oracle and Salesforce, and ended up spending a lot more money than they had originally planned, simply in order to not lose the asset that they had decided was very important strategically.
Well, I think, David, you lived through 2 of these auctions at DoubleClick, which had very different outcomes. So I think people would be interested in the first sale of the company when it was a public company sold to private equity, and then the second sale when you had this kind of competition. Maybe tell that story.
Yeah. Well, the first sale, the other rule of thumb, which again creates a real difficult judgment call, is the best time to sell a company is when you don't have to, and the worst time is when you don't really have a choice. So, the sort of summary of what Jeff is talking about is, to sort of cut back to 2000. If you recall, we had this $15 billion market cap. Part of the reason the market cap shrank so much is we got caught up in the dot-com meltdown. But the other part is we made some really bad strategic decisions. We basically responded to the dot-com meltdown in the opposite way that we should have. What we should have done is doubled down on our core business and emerged from the down cycle in a much stronger competitive and market share position. Instead, what we did is we diversified away from that core business to the extent that when the market turned in 2004 in a positive direction, we were no longer the proxy on the online advertising market that we should have been and that we had been going into the cycle. As a result, the company significantly underperformed, and the board decided to sell the business. It was a controlled sale. All the buyers knew that we had to sell the company. We weren't performing particularly well. And so we had no leverage, and as a result, Hellman & Friedman, which is the private equity company that ended up owning us, bought the company at a very low price. Conversely, fast forward 4 years later to 2008, the way we sold the company at that time was the company was doing great. We were growing revenues at 60-ish% a year on a roughly $400 or $500 million revenue base. Strategically, we were in a great position. We had just launched this ad exchange, which even in the moment, felt like it was going very well. And so basically the way my sort of approach to it was, so my approach to it was I kind of had 2 choices. Sell the company, try to sell the company, or do the default thing of working through an IPO and so on. To tie back to some earlier points that Jeff made, I ended up deciding to sell the company. And the reason, to be totally honest, was the alternative of going public was just not very appealing. As a manager, once you're public, you can't just sell all your stock in one day. You have to sort of dribble it out over 5 years. It looks bad. You have to explain to everybody why you keep on selling stock. Meanwhile, your investors, can sell like that once their lockup comes off. So, to them, an IPO equals liquidity, right? But to the management team, it doesn't, which means you're subject to market whims. And there were no mechanisms at that time to be able to take some money off the table. So it was an all or nothing thing. So on that basis, I tried to explore the option of selling the company. And basically the way I did it was I went out to one bidder. Again, I had this sort of sleeper cell of relationships at some of the large cap internet tech companies. I went to one of them and I kind of induced them over 3 or 4 months and helped them sort of build a strategy to make a bid for us. And then really I turned around and in kind of 2 or 3 days was able to do what I suggested everyone else do, which is, I was in a position to call these other companies and say, look, this company will get sold. You don't have to take a look at it. But if you want to, you need to do it very quickly and you need to make a decision very quickly. And so that led to an auction among 3 companies, Google, Yahoo, and Microsoft. And that resulted in a successful sale of the business at a good price. But what really drove that, we ended up probably doubling the ultimate price over the initial bid, and that was 100% a result of competition versus the first instance where there was no competition and everybody knew that if nobody bid, we would be, we would not be in a good situation. And in fact, in that case, we got a very low price. Which is, again, why I would strongly urge you as entrepreneurs to always think about sort of building this competitive set, because whether you're raising money privately from venture investors or growth investors, or selling 100% of your equity to an acquirer, it sort of doesn't matter. In all cases, you're selling something, you're selling equity, and the more people who want it, the better price you're going to get.
So David, you're being very modest about the value that you added during that 3 or 4 year period. Just give people a sense of what was the opening bid and what was the closing bid?
Yeah. So the opening bid was a range, actually it was a little bit less than 50%, or less than double, but the original range was $1.6 to $1.8 billion for the company. And to cut a long story short, we ended up selling it for $3.1 billion. But the interesting coda to that story is at the end of it, after it was all done, so one of the bidders was Microsoft, whose CEO was Steve Ballmer, who, as most of you probably know, is
real low-key guy.
Yeah, exactly. Probably the single most aggressive kind of testosterone-driven guy in the world. He's in exactly the right job for him right now, owning an NBA team, and so after the whole thing was announced, he called me like within about 5 minutes actually of the announcement, and he said, congratulations on the sale. You should just know, you left at least $1 billion on the table by not giving me the last look. And for various reasons in terms of how the negotiations went with Google, we weren't able to. And then in fact, he went out 4 months later, paid twice as much, $6 billion, for another company, Aquantive, that he thought did a similar thing to us, but which didn't. And
whoops.
A year later, Microsoft wrote down, $6 billion of the $6.1 billion worth that they paid for it, thereby validating the point that we had made to him, which is there was in fact no company like us at the time.
So there's a question I've always wanted to ask you, so now I can ask you because you're on a public forum, is when you go to Yahoo and you work with them for 2 or 3 months and say, look, you should bid to buy our company, and then the next day you call Google and Microsoft and say, Yahoo's bid, do you want to top it? Yahoo knew you were going to do that. How do you get Yahoo to bid knowing they're just setting up to be topped by somebody else? Isn't that a very delicate conversation?
So they told us at the time 5 different ways. If you shop this, we're out of here. And so, yeah, I mean, there's a heart and mouth moment, I think, to every significant transaction. And mine in that case was when I picked up the phone to call the other guys. But it was sort of a calculated bet, and you have to take risks in life. And part of the advantage, though, what gives you more courage in that is if the core business is performing well, it makes you a lot braver because it means that you're, as they sort of say in business school, your BATNA, your best alternative to a negotiated agreement. Your BATNA is not bad. It's not as good as selling the company at a premium, but it's not bad. That plus the fact that I had, again, built this sort of sleeper cell, and I knew that there were individuals in each of the other bidders who very quickly could articulate the argument for why they needed to own it and why it'd be really bad for them if somebody else owned it.
So when you made that call, you took a risk, maybe a calculated risk, but you took a risk that Google and Microsoft wouldn't bid, that Yahoo would find out, get upset, and withdraw their bid. So there was some
or
some
somewhere
risk.
in the middle that Google and Microsoft would take a long time. In the Yahoo would find out, they would pull out, and then everyone would seem to make us less attractive.
Yeah.
And it sort of has this self-reinforcing effect. I'll tell you one other funny story is, for some reason, there was that 1 week where we were sort of flying around the country and kind of giving the company presentation to a much larger acquisition team at each of the acquirers. And so we had this meeting at Yahoo. We had the meeting at Microsoft. For some reason, the meeting with Google to do this was in New York. And so my partner and I, who ran product at the time, took the red eye back from Seattle back to New York to present to Google. And in the Microsoft meeting, and at the time, Microsoft regarded Google as its biggest competitor and vice versa. And for some reason, so we as part of the presentation, we had a model that said, this is the value to Microsoft of owning DoubleClick, and then same thing to Google. And so, we were in this hotel room. It was like packed, yeah. And we'd sort of gone through the deck on the red eye, meaning neither of us had slept a minute on the way there. And we basically did a kind of find and replace Microsoft or Google on the deck. And when we got to the presentation, we went through 80% of it. It was totally fine. And then we got to the kind of Excel spreadsheet, which we had pasted into a PowerPoint slide. and at the bottom it said value to Microsoft of owning Google. And I remember there was this Susan Wojcicki, who's fantastic, who was the sort of executive sponsor of this deal and now runs YouTube, said, excuse me, why does that say value to Microsoft? And honestly, my partner and I were so tired, and we weren't thinking well on our feet. And so I didn't say anything. He said, it's a typo. But we accomplished our mission. And then, we had bankers. And it was interesting, we had bankers in the room from Morgan Stanley. And, I guess they seized the opportunity without talking to us. The next day in the Wall Street Journal, there was an article that said, Microsoft evaluating, a purchase of DoubleClick, which I think further incited both Yahoo and Google.
It's now in the Morgan Stanley playbook.
Yeah, right.
Page 17.
That's subliminal advertising.
Yeah, right.
Yeah, not so subliminal.
Right.
So we only have a few more minutes, and I just want to get any questions for this group? Yes, sir?
One question from the entrepreneur's perspective, and I don't know if your companies do this, but how should an entrepreneur think about corporate venture, right? I'm involved in finance, so a lot of the banks have venture units. How do or is it nefarious? Are they strategic?
What, you mean taking money
Taking
from a
money from a
corporate
strategic
venture
investor.
group as opposed
That's
to
a
a...
good question.
Yeah. Look, I'll give you my point of view, which is I think your first responsibility as an entrepreneur is to have your company be well enough funded. And so, if the best offer is from a corporate and you don't have compelling offers from alternatives, then you got to take it. I will say that in almost all cases, but not all, the corporate investment comes with both a board seat from that company and a promise of some sort of strategic help. And I would say, just from my experience, in almost every single case, and there are obviously exceptions, the corporate guy who's on your board, within a year is assigned to something else, has a different job, leaves, he's either not replaced or he's replaced by someone else who doesn't really understand the business or why the investment was made originally. And at best it becomes neutral, at worst it becomes this person you have to deal with that doesn't really understand what you do or why he or she is there. And then similarly from the sort of synergy or kind of operational synergy side, usually it doesn't really pan out because it's incredibly important to the target company. It's not particularly important to the investor. Again, team switch, strategy shift, priority shift, even within companies. And so, to the extent, assuming you do have a choice between a corporate or a strategic and a financial investor, and terms and all that kind of stuff are roughly comparable, and valuation is roughly comparable, and you have this choice, I would just say, be careful of being seduced by the promises of what the big company can deliver, and just make sure that, yes, you trust on one hand, but on the other, you verify, and you make sure that whatever value you expect to get is to the extent you can, is both contractually and also supported by the CEO, and that you get some kind of, as much of a commitment as you can that it'll actually happen, because chances are, even if you get that, it's probably not going to materialize.
I would just add that, and that's all, I think, right on the mark. There's always a risk with one strategic investor that the world sees you as just no longer truly independent actor, that you're somehow in their sphere of influence. The best way to inoculate yourself against that is to try to find two strategics at once. And I kind of learned this lesson only from clients. That's how I learned a lot of things. When I represented a company called Red Hat, was doing its initial Series A financing with Benchmark and Greylock. They were an open source operating system. Linux was their product. This was at a time when the idea of open source code in the enterprise was novel and somewhat exotic. And so the management team wanted the validation of having a strategic, and IBM was very interested in putting money in. We concluded that the best way to avoid being seen as an IBM vassal state was to find another strategic, and so Novell came in alongside them. So, I think we have time for one more. Yes, sir.
This is tough. So the follow-up question. So if, since you both sit on the boards of the Priceline Twitter, so if one of the entrepreneurs came in and say, we don't want to sell to you because of that kind of empty promise you have, how do you persuade them to sell to you? So counter argument.
Did you hear it?
Could you repeat the question? I'm not sure.
And how do you offer a counter argument to persuade entrepreneurs to sell to a corporate VC?
Oh, to a corporate VC?
Yeah.
There are a couple of answers to that. One is there are different kinds of corporate VCs. So, for instance, Comcast Ventures and SAP Ventures are organized like regular venture capital firms. They have an independent fund. The partners get a fee and carry in the fund. They are paid only on the financial return on the investments. Whereas other corporate venture funds like Intel, they're executives of Intel. They might come into the venture group and then leave the venture group. And their incentive is to improve Intel's business, not make a financial return. So if you are a financial fund set up like a venture capital fund, but where your only limited partner is a corporation, I think you can make a very strong argument that you're very similar to a venture capital fund. And then the second thing you could do is if you're good, and in fact you add a lot of value, for instance, if you're Comcast, and you can say, look, we can distribute your product in 50 million homes in the United States, that's enormously valuable to you, and here are the 5 CEOs of portfolio companies that we've invested in the last 5 years, call them up and ask them what their life was like before we invested and ask how many homes they're distributed to now, and Comcast added enormous value, then that's just a tremendous thing to do. So I think the reference call, if you are an entrepreneur and you're getting investment from anyone, whether it's a corporate venture capital firm or anyone else, the single most important thing for you to do is to find CEOs that that venture capital firm and that partner have invested in before. If you can, find a company that failed that venture capital firm and that partner invested before, because the companies that are good are going to give you good references. You want to find the companies that struggled.
The ones that aren't on the website anymore.
Right. And how did the venture capital investor, how good a partner were they when times were tough? Yeah. And that's where it separates the best VC partners from whether they're corporate or not.
Yeah, by the way, I can't reinforce that strongly enough. And it seems like no one ever really does it, but that is the only thing that matters. Everyone is your friend when things go well. And what really separates good firms from not as good firms is how they treat partners who do not do well, because the reality is the likelihood is that you're not going to do as well as you thought you were going to. And having supportive partners really, really is important.
You also want investors with intellectual integrity and character. And Bessemer, which is Jeff's firm, do you still have this for years, had their anti-portfolio up on their website, which were an acknowledgement of deals they did not invest in and turned down that went on to great success. Okay, that's I think reflects very well in Bessemer. And with that note, I just want to thank our speakers. We're done. Elaine's going to take us straight.
Great. Phil, thank you very much. Terrific. Thank you. Great job. That's great.
All right, so we just want to say a few closing remarks as we wrap up today's first Yale Tech Conference in New York City. One of our hopes with starting this alumni shared interest group is to build a stronger community of Yalees who are involved in entrepreneurship and technology, and I think this is a fantastic start. An event like this really couldn't happen without the support of many of our partners. We've had fantastic support from the Yale Entrepreneurial Institute, the Yale Club of New York City, especially Sandy Lee and Andrew Bezic, the AYA and Mickey Dobbs, General Assembly, Paper G, and Goodwin Procter and Bill Schnorr. So let's give a round of applause to all the sponsors who helped make this possible. We also had a fantastic volunteer team today who helped to make everything run smoothly. So I just want to say a thank you to April Koh, Greg Hauschier, Cece Nee, Reed Emmer, Steve Bogdan, and Yang Zhao, who all helped us make this event run. And then, of course, to Victor Wong, who is one of the organizers, along with Rich and I. So thank you to all our volunteers for making this a great event.
This is on. I just want to echo those comments, and one quick follow-up is just a suggestion from personal experience. The reason we get everybody together is also to have people meet each other. Yaleys are very friendly. There have been so many times that I've reached out for help, whether it's for investment, whether it's for advice, and I just would encourage everyone to both seek help and offer help, because that's something that's going to make our community stronger and better. And really people in this community are incredible with it, so I'd encourage you to do that. And on that note, Greg and Cece have been doing an incredible job organizing events in New York City where there are regular meetups, dinners, events, and so I would encourage you on the way out to find them, meet them, sign up for the email list. Some of the events have been great. And I guess, to end, we have an open bar upstairs on the 22nd floor with a great view of New York, and would love to see you there too. Thanks everyone for coming.